The element of valuation is an aspect of where you've actually invested your money. What kind of investments have you actually taken up? You could be running a business. You could have bought bonds in the stock market or from the government. You could be invested in the stock exchange through listed shares. You could be investing in real estate and all that. And all these aspects of investments are impacted differently by COVID-19. If I could touch in a short way what some of those effects will be. If you look at short-term investments, the impact of COVID actually on short-term investment will be quite muted. And I'm looking at investments like money market fund investments, fixed deposits with banks up to 12 months. And I'm also looking at treasury bills investments. Those ones will have very limited impact because for most of them, you've already fixed the rate of return you're earning. And it's unlikely that credit risk in each of them will deteriorate so fast to actually make them untenable. So it's a good thing to actually have short-term investments. But of course, clients ought to be concerned about the kind of underlying investments each of those, for example, money market funds have invested in, or even the overall credit quality of investments in banks. We're not saying there's an immediate risk, but obviously over time, then you actually see the need to evaluate that risk. If you think about investment in corporate bonds, of course, new risks are starting to present themselves in terms of the default risk or the ratings of some of these issuers. So one will need to evaluate what risk from a default perspective each of these is posing to make sure that then you're not exposed to companies that that pose a very huge risk. One way of looking at that is to actually evaluate the return some of these papers are paying you vis-a-vis where the general market is. Very high return is always an indicator of the level of risk that you're taking, but it's an item you want to evaluate on a case-by-case basis. Yeah, treasury bonds have become the safe haven as far as investors are concerned, generally because in any jurisdiction, investing in the government is considered to be risk-free. So the only risk then you have to contend with is should you need to sell that treasury bond in the nearness of time or before it matures. And our view of treasury bonds investment is that as much as it poses valuation risk, for someone who has a long-term mindset, then interest rates curves always even out. And so the valuation risk will actually even out over time. So it's actually a good investment to start picking up in these trying times. I mean, it's also important to actually state that we have two types of bonds, some that will come with a tax benefit, that they're tax-free, others are taxable. One needs to evaluate based on your tax characteristic as to how you invest in those. But they offer very good safety nets in terms like such. Some people will invest in Eurobonds. Eurobonds are generally dollar-based investments issued by countries. So, for example, Kenya has issued Eurobonds, a number of them. Eurobonds, unfortunately, are going a very tumultuous time as far as valuation is concerned, and the reason is because main investors of Eurobonds are foreigners. And with increasing risk, people are running away from smaller economies. And so that's posing substantial risk as far as valuation is concerned. But that doesn't mean, or that doesn't translate to default risk in the long term. We actually think they're still good investments, and anyone who actually want to start gaining dollar exposure with a long-term view could take advantage of the current yields. Because look at it, you can have a Kenyan bond maturing 2024, giving you a yield of 6 to 7%. That's a really good return over the long term. And it's something that will actually encourage clients to continue looking at. If you're already exposed, it's not time to panic. We shall even out this, and eventually you'll get back to your return levels. Listed securities is where maybe the most jitters are in. Because people feel like they've actually lost a lot of their wealth. And it's true, actually, because over the last month and a half, you probably lost 25% of the valuations in the market. One can decide to look at it in one of two ways. I've lost all the opportunities. Of course, if you want to look at the losses, you'll actually start panicking, which is not the right thing to do because generally these companies will come back in terms of returns. So one wants to avoid panicking at this point in time and allowing this go through the cycle. And if you're sitting on liquidity, it's also possible to start identifying good buying opportunities as far as the stock market is concerned. But we'll talk about those towards, at a later stage. Real estate, a very interesting space to actually look at, presenting opportunities and risks. One of the risky portions of the real estate market is actually the middle income market, where, for example, people dependent on banking financing to actually, offload, for example, residential units and all that. Because of how tight the credit market has been, then people are actually starting to de-risk. People may also get impossible foreclosure as far as ability to repay is concerned, especially so if we continue to the trends of people losing jobs and all that. So what you probably notice is that prices are coming off. You'll probably see a property that was retailing at 25 million, for example, coming down to 23, and there are possibilities that will still keep coming down. There are opportunities sitting there, but one also needs to evaluate, because you could also be sitting on further opportunities for prices to actually go down. So it's one that you want to enter in carefully, but at the same time evaluate, getting advice from professional property valuers and people understand the properties market. Of course, the item is your business. Your business is really dependent on what sector of the market you're in. There's certainly sectors that will really flourish despite the challenges we are going through. The others that will lag. Evaluation will need to be on a case-by-case basis to actually decide what next you ought to do as far as your business is concerned. Obviously, a number of them will need support from financiers to access credit and maybe get the moratoriums, as we've been talking about broadly in the environment.
NCBA.